You're listening to the Valley Current.
Imagine walking into a Wall Street bank, asking for $75 billion, and then telling the most powerful financiers on Earth that their ultimate payoff depends on whether or not you can successfully put 1 million people on the surface of Mars. I mean, Welcome to our deep dive.
Yeah, it really sounds like the pitch for a science fiction novel, but it is actually the central premise of what we're looking at today.
Exactly. And we are so thrilled to have you with us for this custom-tailored analysis. Today, our mission is to unpack a single, incredibly dense special report that just dropped.
Right.
It's from Computer Law Group, LLP, or CLG, dated April 23, 2026, authored by their managing partner, Jack Russo. And the subject of this report is SpaceX's highly confidential S1 filing, which is currently operating under the codename Project Apex.
Project Apex.
Right. And our goal here is to figure out if this is actually going to be the biggest initial public offering in the history of global finance to, decipher the truly unprecedented legal and structural maneuvers buried in this document.
And there are a lot of them.
Oh, there are so many. And most importantly, we want to figure out what this means for you. Whether you are an institutional investor trying to build a financial model for this, a tech founder looking at how the rules of the game are fundamentally changing, or just someone fascinated by this wild collision of space exploration, artificial intelligence in Wall Street.
It really is a nexus event. I mean, we are not just looking at a company raising money here. We are looking at an event that actively stress tests the established architecture of global capitalism.
Okay, let's unpack this.
Yeah.
Because you're asking the market for $75 billion at a $1.75 trillion post-money valuation.
Right.
That begs the obvious question. What exactly does a number that large actually mean in the real world? Because, let's be real, we throw around words like trillion and billion so often now that they start to lose their way. So let's ground this.
Yeah, we have to. The numbers are the foundation of everything else we are going to discuss today. Because according to the leaked confidential filing details in the CLG report, SpaceX filed this S1 on April 1st, 2026. And they are targeting a formal roadshow for the week of June 8, with pricing slated for mid-June.
Yeah.
And that target, a $75 billion raise, is just staggering.
It's hard to even picture.
It is. I mean, to put that in historical context, up until now, the undisputed heavyweight champion of IPOs was Saudi Aramco. In December 2019, they raised $29.4 billion.
Right, the state-owned oil giant of Saudi Arabia.
Exactly. And the U.S. record holder is still Alibaba from September 2014, which raised $25 billion. So a $75 billion raise isn't just breaking the record. It is taking the Saudi Aramco IPO, the Alibaba IPO, and SoftBank Corp's 2018 listing, which was $23.5 billion, and combining all three of them into one single transaction.
Wait, so you're saying all three of the biggest IPOs in history combined barely equal this one?
Barely. Historically, when a new largest ever IPO happens, the record inches up by, a billion or two. To go from a previous absolute ceiling of $29.4 billion to $75 billion is a 155% leap.
Which honestly makes me want to push back right out of the gate here. Are the public markets actually deep enough to swallow a $75 billion single gulp without choking?
That's the...
I mean, you are talking about pulling $75 billion of primary capital out of the ecosystem in a matter of days? Can the system handle that kind of massive liquidity drain without collateral damage?
That is the existential question of the 2026 market, honestly, and it's a brilliant point to raise. The short answer is, well, nobody knows for sure because it has literally never been attempted.
Right.
The global capital exists, certainly, but institutional capital allocation budgets, the models that giant pension funds and mutual funds use to decide where to put their cash, they are not designed to absorb a single $75 billion equity issuance in one quarter without aggressively rebalancing.
Rebalancing meaning they have to sell off other stocks just to free up the cash to buy into SpaceX.
Precisely. You could see a temporary depression in other large-cap tech stocks simply because asset managers need the liquidity to participate in Project Apex. A raise of this size requires massive participation from sovereign wealth funds, giant global pension funds, and as we'll discuss later, an unprecedented reliance on retail investors.
Okay.
If Project Apex succeeds at this target, it permanently resets the goalposts for global liquidity.
It changes the definition of what a public market can actually do, like a financial planetary alignment.
Yes. It proves that public markets can provide sovereign-level liquidity. If this works, it could fundamentally change how sovereign wealth funds operate, or how entire nations think about privatizing their crown jewel assets, because the theoretical capacity of the market will have been proven to be vastly larger than previously assumed.
Okay, so if you are asking the world for that kind of unprecedented liquidity, valuing yourself at $1.75 trillion, what exactly are investors buying? Because when you peek under the hood of this S1, this isn't just a company that builds rockets anymore, is it?
Not at all. It has evolved into an incredibly complex, somewhat contradictory conglomerate. The CLG report highlights a massive structural shift. In February 2026, SpaceX executed an all-stock acquisition of xAI.
Right, the AI company.
Yes. This deal valued the combined entity at $1.25 trillion at the time, with xAI valued at $250 billion, and the legacy SpaceX business at $1 trillion.
So they essentially swallowed an artificial intelligence company whole right before filing to go public.
Exactly. So we're looking at consolidated 2025 results that are deeply impacted by this merger. And the numbers tell a story of two very different businesses living under one roof.
Okay, what did the numbers look like?
The consolidated revenue for 2025 was $18.7 billion, but the net loss was $5.0 billion. Capital expenditures were a massive $21 billion, and total debt sits at $23 billion.
Wait, I'm looking at this consolidated balance sheet since the xAI merger, and it looks incredibly messy. They are generating almost $19 billion in revenue, but losing $5 billion.
Yeah, the loss is heavy.
How are they justifying a $1.75 trillion valuation with a $5 billion net loss? That doesn't make sense to me.
To make sense of it, you really have to split the business in half into what the report categorizes as the engine and the anchor.
Okay, the engine and the anchor, I like that.
The engine is the legacy space business, specifically Starlink. The economics of Starlink are the primary financial justification for the valuation. By early 2026, Starlink crossed 10 million subscribers.
Wow.
And Space, which is an analytics firm cited in the report, projects 16.8 million subscribers by the end of the year. That single segment generated $11.4 billion in revenue in 2025, with an astonishing 63% adjusted EBITDA margin.
Okay, let's pause there and explain EBITDA for anyone who isn't, a financial analyst. Why is that specific acronym so critical when we're talking about a space company?
Sure. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is essentially a proxy for the raw operational cash flow a business generates from its core activities, stripping out the heavy accounting costs of the massive equipment they have to buy.
Because they buy a lot of equipment.
Exactly. For a company like SpaceX, which spends billions building rockets and satellites, their depreciation costs are astronomical. If you just looked at their raw net income, it would look terrible because of that depreciation.
Because the accountants say the rockets lose value over time.
Exactly. But EBITDA lets investors see the actual cash being generated by the underlying service before those accounting charges.
Got it. And a 63% margin on that is huge.
It is practically unheard of in telecom. The report compares this to traditional terrestrial internet providers. Comcast sits at a 31% margin. Verizon Fios is around 35%. Starlink is nearly double that.
And here's where it gets really interesting to me. My favorite analogy for Starlink is it's a high-speed fiber internet network that magically doesn't have to pay for the ground it's buried in.
That's a great way to put it.
Right. Because they have bypassed the entire physical, geographical bottleneck of laying copper wire or fiber optic cables across mountains and oceans. Once the satellite is up there, adding a new subscriber costs them almost nothing. It's basically a license to print high-margin cash.
Absolutely.
Plus, their average revenue per user isn't just a standard $85 a month consumer bill. The report notes they are charging aviation clients up to $300,000 a year for in-flight Wi-Fi.
And you have to factor in the $17 billion spectrum deal they just signed with EchoStar.
Oh, right.
That deal is designed to unlock direct-to-cell service, meaning your standard smartphone will connect directly to a Starlink satellite, bypassing traditional cell towers entirely. They are targeting 25 million monthly active users for that service alone.
That is massive.
It is. When you combine that with their traditional launch business, they flew 167 Falcon 9 missions in 2025, which is an operational cadence no one on Earth can match. You have an incredibly robust cash-generating engine.
But then you juxtapose that engine against the anchor, and the anchor is xAI. This is the part of the balance sheet that is burning cash like rocket fuel. Right?
That's the crux of the financial tension in this prospectus, yeah. The report estimates that XAI burned $9.5 billion in the first 9 months of 2025 against only about $210 million in actual revenue.
How?
It's an infrastructure build-out phase. They're buying hundreds of thousands of advanced graphical processing units, or GPUs, to train their AI models. And it drove the company's debt up significantly. They took on a $4.5 billion AI infrastructure lease through Valor Equity just for those chips, and another $5 billion high-yield debt package arranged by Morgan Stanley.
So you have a highly profitable space communications business essentially subsidizing one of the most capital-intensive AI buildouts in human history. How does Wall Street look at that? Do they look at the debt and panic?
What's fascinating here is how the rating agencies and bankers are treating it. The report notes that to clean this up before the IPO filing, the combined entity reportedly paid down roughly $17.5 billion of legacy obligations in March 2026.
That's a huge paydown.
It is. Because of that aggressive paydown, when you look at the projected $14 billion of consolidated EBITDA for 2026, the pro forma leverage sits at roughly 1.6 times. And in the world of heavy industry, 1.6 times leverage is considered remarkably lean.
Okay, I have to push back hard on this. Lean. They have $23 billion in total debt, and they are actively burning $9.5 billion on AI chips with almost no revenue to show for it yet. How can Wall Street possibly view that as lean just because of Starlink's projection?
It's a fair challenge.
Yeah.
I mean, lean is relative. Let's break down pro forma leverage. Leverage is essentially a ratio, total debt divided by EBITDA. It tells you how many years of current cash flow it would take to pay off all the debt if you spent every single penny of profit on debt reduction.
Okay.
So if you have $23 billion in debt, but you are reliably generating $14 billion a year in core operational cash flow, that's a ratio of roughly 1.6. A typical telecommunications company might operate with a leverage ratio of 3 or 4 times. A leveraged buyout by a private equity firm might push that to 6 or 7 times.
Ah, I see. So because the denominator, like the cash generated by Starlink, is so massive, it just dwarfs the sheer dollar amount of the debt.
Exactly. When bankers see a 1.6x ratio for an aerospace company executing $21 billion in annual capital expenditures, building the massive Starship V3, deploying second-generation satellites, building enormous new data centers in Tennessee, it signals underlying financial durability.
Right.
It shows the rating agencies that despite the massive cash bonfire happening over at XAI, the overall enterprise is not dangerously over-leveraged heading into the public markets. They have the cash flow to service that debt comfortably.
Okay, but just because they have the cash flow doesn't mean they aren't making some incredibly aggressive, borderline, baffling structural moves with that cash, which, brings us to the $60 billion elephant in the room.
Yes.
The Cursor deal.
Yes, the Cursor deal.
We just talked about the massive financial drag of XAI, but instead of pulling back, SpaceX is doubling down on AI infrastructure on the absolute eve of going public. And they're doing it in a way that the CLG report calls the strangest pre-IPO M&A maneuver in tech history.
Structurally, it is baffling at first glance.
Yeah.
On April 21, 2026, SpaceX announced a $60 billion option to acquire a company called Anysphere Inc., which is better known by its product name Cursor later in 2026.
Cursor's an AI coding assistant, right? It basically writes software code for developers.
Correct. And their growth has been explosive. Founded by 4 MIT engineers, they went from $100 million in annual recurring revenue in January 2025 to $1 billion by November to $2 billion by February 2026.
That's insane growth.
It is. Their last private funding round, the Series D, valued them at $29.3 billion. SpaceX is stepping in and saying, we want the right to buy you for $60 billion. But the structure of this deal is bizarre. It includes a $10 billion with a B collaboration or breakup fee if SpaceX ultimately decides not to exercise the option.
Wait, let me get this straight. They're putting down a $10 billion non-refundable deposit to buy an AI coding company, but deliberately scheduling the actual purchase to happen after they go public.
Yes.
Is this strategic brilliance to lock in an asset, or is this just a highly engineered way to dodge SEC scrutiny before the IPO? I mean, what is going on here?
It is an absolute masterclass in regulatory engineering. To understand why this is so clever, we really have to talk about the mechanics of SEC Regulation SX, specifically Rule 305 and Article 11.
Okay, unpack those rules for us. Because imagine I'm an ambitious startup founder, but I don't speak SEC accounting.
Sure. So if you're a company going public
Yep.
and you acquire a significant business right before your IPO, the SEC demands transparency. They require you to provide fully audited historical financial statements for the company you are buying.
Okay.
And you also have to provide pro forma financial statements showing what the new combined mega company will look like.
Which makes sense. If I'm buying SpaceX stock, I want to know exactly what SpaceX is buying with my money.
Exactly. But here's the mechanical problem. Getting audited financials for a hyper-growth startup that just went from $100 million to $2 billion in revenue in 14 months is an absolute nightmare.
Because their books are probably a mess.
Right. A startup growing that fast usually has messy books. They are focused on scaling, not on rigorous compliance accounting. A full audit by a Big Four accounting firm to meet public market standards could take 6 to 9 months.
And if SpaceX signed a standard merger agreement to buy Cursor today, they would have to pause their entire IPO process to wait for those auditors to finish their work.
Precisely. It would completely destroy their target of a June roadshow. But by structuring this as a call option, meaning SpaceX simply bought the right to buy Cursor rather than actually buying the company today, and specifying that this option cannot close until after the IPO is effective, SpaceX sidesteps those SEC requirements entirely.
That is so sneaky.
The CLG report notes that because it's just an option, the upfront financial commitment falls below the 20% SEC significance threshold.
Yeah.
Therefore, no immediate audits are required, and the IPO timeline remains intact.
That is brilliant. But what about that $10 billion breakup fee? I mean, that is 16.7% of the total purchase price.
Yep.
Standard corporate breakup fees are usually what, 1 to 5%?
Yeah, typically 1 to 5%.
If a deal falls through, you pay a small penalty. $10 billion seems like an insane premium just for optionality.
It is historically unprecedented.
Mm-hmm.
In the world of corporate mergers, there is a famous Delaware Supreme Court case called Brazen v. Bell Atlantic.
Okay.
That case established the legal doctrine around the reasonableness of termination fees. Courts generally frown upon breakup fees that are so massive they act as a coercive penalty. If a fee is so huge that a board of directors feels forced to complete a bad deal just to avoid the penalty, the courts will strike it down.
But the CLG analysis points out that the Delaware doctrine doesn't cleanly apply here. Why not?
Because this isn't a traditional deal protection device. It is better characterized as a prepaid option premium. Think of it like a $10 billion insurance policy.
An insurance policy?
Yeah. SpaceX is paying Cursor $10 billion right now for the exclusive right to buy them later. It guarantees access to Cursor's incredible AI coding technology while legally deferring the regulatory headache of an audit until after SpaceX is flush with $75 billion in public capital.
Wow. And, you mentioned Delaware law just now, and that is the perfect organic transition to our next major theme. Because to authorize a $10 billion non-refundable deposit without your shareholders launching a massive mutiny, you need a very specific, unquestioned kind of corporate control.
You really do.
And this leads us to how SpaceX is legally structured to protect its CEO from that exact kind of pushback.
The governance structure of this IPO is just as radical as the financial scale we've been discussing.
The report details a dual-class share structure. Class A shares get 1 vote per share. Class B shares get 10 votes per share. Through this mechanism, Elon Musk retains about 42% of the economic ownership of the company, meaning his share of the profits, but he holds a massive 79% of the voting power.
Right.
And crucially, there is no sunset provision, meaning this control is perpetual. To put that in perspective, Mark Zuckerberg had about 55.9% voting power when Facebook IPO'd. This is closer to the absolute lockdown control the founders of Snap retained. But the real twist, the real legal maneuvering, happened on February 14th, 2024.
The Texas pivot.
Exactly. SpaceX officially reincorporated, moving its legal corporate home from Delaware to a Texas Public Benefit Corporation, or PBC. And the timing here is absolutely critical. It happened just days after a Delaware judge, Chancellor Kathleen McCormick, rescinded Musk's historic $55.8 billion compensation package at Tesla in a case called Tornetta v. Musk. Now, as a side note, the Delaware Supreme Court did reverse the remedy in that case later in 2025, but the underlying liability findings about how Musk controlled the board remained. So SpaceX packs its legal bags and moves to Texas. What does escaping Delaware actually mean in practice?
The significance of that move cannot be overstated. For over a century, Delaware has been the undisputed home of American corporate law. Investors trust Delaware. Institutional money trusts Delaware.
Because it's predictable.
Exactly. Because it has 125 years of deeply established, highly predictable case law.
Give me some examples. What kind of case law are we talking about here?
Things like the Unaccall Doctrine, which strictly governs what defensive measures a board can take against a hostile takeover. Or the Revlon Doctrine, which dictates that if a company is definitely being sold, the board has an absolute duty to get the highest possible price for shareholders, regardless of their own preferences. Or the MFW Framework, which outlines exactly how a company must handle transactions involving a controlling shareholder to ensure the minority shareholders aren't getting fleeced. This body of law creates a safety net for investors. They know exactly how a Delaware judge will rule in a dispute.
But predictability and minority shareholder protection aren't exactly the goals here, are they?
Precisely. By executing the Texas pivot, SpaceX is legally leaving that 125-year safety net behind. The Texas Business Organizations Code, which was significantly strengthened by state legislation known as SB 29 in 2025, allows for the exact same dual-class share architecture as Delaware.
But without the strict judges.
Right. It offers a far more founder-favorable judicial environment. It essentially shields the controlling shareholder from the strict, agonizing, equitable reviews that Delaware chancery courts are famous for applying when minority shareholders sue over unfair treatment.
And the CLG report points out something else. SpaceX qualifies as a controlled company under major exchange listing standards, like NASDAQ.
Yeah, that's huge.
Let me explain it this way for you listening. Imagine a massive ship. Normally, corporate governance rules say the captain has to listen to an independent committee of officers to ensure he doesn't sail the ship into a hurricane and kill the crew. But controlled company status means SpaceX is legally exempt from having a majority independent board of directors.
That's right.
They are exempt from having an independent compensation committee or an independent nominating committee. It's a captain who literally never has to listen to a mutiny because mutiny is basically against the rules.
That is a very apt analogy. And when you don't have an independent compensation committee to act as a check and balance, when you don't have a group of independent directors asking, is this fair? It allows for executive compensation structures that would be literally impossible to pass anywhere else.
Which brings us to what might be the single wildest part of this entire S1 filing. Because if no one can stop you from writing your own compensation plan, how do you pay yourself? The answer, apparently, is with the most unprecedented vesting milestones in the history of capitalism.
The compensation disclosures here border on science fiction, but we have to remember, these are binding legal documents filed with the federal government.
There are two separate compensation plans outlined in the leaked prospectus. Plan 1 awards 60 million shares to the CEO, and they vest in tranches as the company's valuation grows from that 1.75 trillion starting point all the way up to 6.6 trillion.
Massive jump.
Right. But it's not just financial. The vesting is also tied to a highly specific technical milestone, the deployment of space-based data centers capable of delivering 100 terawatts of compute power, which, by the way, is a staggering, almost unfathomable amount of energy. But then we get to Plan 2.
This is where it gets crazy.
Plan 2 awards 200 million shares, and the sole vesting condition for those 200 million shares is the establishment of a permanent Mars colony with at least 1 million inhabitants.
It is breathtaking in its audacity.
I read this and I honestly feel like I'm looking at an absurd video game achievement. Unlock 200 million shares by colonizing a new planet. How does Wall Street, or the SEC for that matter, even begin to process this?
This raises an incredibly thorny question, and it's one that is going to keep SEC accountants and corporate lawyers arguing for the next decade. There are very strict accounting rules, specifically a standard called ASC 718, and disclosure requirements under Item 402B of Regulation SK.
Okay, translate that for us. What do those rules actually say?
Those rules dictate how a public company must account for and report executive compensation that is tied to performance. Normally, a performance milestone is something tangible and terrestrial, hitting a specific revenue target or a market capitalization goal.
Things you can measure on Earth.
Exactly. If you hit the goal, the company has to recognize the cost of those shares as an expense on their income statement.
Right.
But a Mars colony.
Right. How do you audit 1 million people on Mars? Do you send a Big Four accountant on a 6-month space flight to do a head count? Are you kidding me?
Exactly. The legal and accounting friction here is whether a milestone that is so profoundly speculative, so deeply extraterrestrial, can even be considered performance-based in its economic substance.
Because it's so far out there.
Right. If it's a vanity project that has no bearing on terrestrial cash flows, does it trigger adverse accounting treatment? The major proxy advisory firms like Institutional Shareholder Services, or ISS, and Glass Lewis exist to advise big pension funds on how to vote on corporate issues. They will almost certainly recommend that institutional shareholders vote against these pay packages, arguing they're completely disconnected from traditional shareholder value.
But because of that controlled company status we just talked about and the 79% voting power, that institutional vote doesn't actually matter, does it?
It is strictly an advisory vote. The controlling shareholder will approve the package regardless of institutional objections. But the real significance is rhetorical. It forces the public markets to formally acknowledge in a binding SEC document that the goal of this publicly traded corporation is not just quarterly earnings, but the multiplanetary evolution of the human species.
Speaking of forcing the market to accept things they usually wouldn't, let's pivot to how SpaceX is treating the banks. We've seen how they defy standard corporate governance norms. Now let's look at the syndicate.
The syndicate, yeah.
For those listening, the syndicate is the group of investment banks actually managing and underwriting this massive IPO.
The power dynamics in this syndicate are completely inverted from historical norms. Usually, Wall Street dictates the terms to the company. Here, the company is dictating terms to Wall Street.
There are 21 banks involved in the Project Apex syndicate, but the real story is the top 5. Bank of America, Citigroup, Goldman Sachs, JP Morgan, and Morgan Stanley. In the prospectus, these 5 titans of Wall Street are listed alphabetically on the cover.
Which is a massive slight in the world of high finance.
Exactly. There is no designated lead-left bank holding the premier billing, and the fees are incredibly compressed. The CLG report projects fees of roughly 0.75% to 1.0% of the total raise.
That's so low.
That generates a total fee pool of maybe $560 million to $750 million to be split among the banks. Now, to the average person, that sounds like an ocean of money. But the financial press was expecting the standard 2% fee on a mega IPO, which would have been $1.5 billion. Wall Street is taking a massive, humiliating haircut.
To understand the insult of the alphabetical listing, you really have to understand investment banking, ego, and mechanics. The lead left position, meaning your bank's logo is literally printed in the top left corner of the S1 prospectus, is the most fiercely contested prize on Wall Street.
What does being led left actually get you besides, bragging rights?
Tangible power and money. The lead left bank runs the order book, meaning they decide which institutional clients get how many shares. They act as the stabilization agent, meaning they control the buying and selling immediately after the stock starts trading to prevent the price from crashing.
Oh, wow.
They get definitive league table credit, which is a scorecard banks use to rank themselves globally. And most importantly, the lead left typically captures 25% to 30% of the total fee pool, all for themselves. By listing them alphabetically, SpaceX is explicitly stripping away that prestige and that outsized payout. They actually did this in the Saudi Aramco and Alibaba IPOs as well, but it still stings.
So why did the banks take it? If they're losing prestige, being treated like interchangeable commodities, and taking a massive 50% cut on their expected fees, why are giants like Michael Grimes at Morgan Stanley, who, by the way, the polymarket betting odds have at 89.5% to be the actual behind-the-scenes stabilization agent, why are people like him or Kim Posnet at Goldman Sachs agreeing to these terms?
Because the deal is simply too big to miss. If you are a global investment bank, your entire brand is built on being at the center of global capital flows. You cannot sit in a boardroom and explain to your major institutional clients why you were left out of the largest capital markets event in human history.
Right, it would be a disaster for them.
SpaceX knows this. Their CFO, Brett Johnson, knows this. He is utilizing the sheer gravity of a $75 billion deal to bend Wall Street to his will.
But it's not just the banks being dictated to. Let's talk about who is actually going to be buying these shares. The report notes a 30% retail allocation, meaning 30% of the shares in this IPO are being reserved specifically for everyday mom-and-pop retail investors, facilitated through platforms like Morgan Stanley's E-Trade and Goldman's Marcus Invest.
That is an extraordinarily high number. A normal IPO might reserve 5%, maybe 10% for retail investors.
Right. So what does this mean for the person listening to this? If you log into your E-Trade account next June, are you actually going to get a piece of this? Or is this just a calculated move? Is this really about democratizing finance for the little guy? Or is it a calculated maneuver to build a massive fiercely loyal political constituency.
It is undoubtedly a dual motive. On one hand, it does align with the populist ethos of allowing everyday retail investors access to what could be a generational wealth creation vehicle, rather than letting the venture capitalists and hedge funds capture all the upside. But strategically, you have to look at the defensive nature of this move. When a company is deeply enmeshed in heavy industry, massive government contracts, and complex regulatory battles, having millions of everyday retail shareholders creates a formidable political shield.
A human shield of retail voters.
Exactly. An institutional investor, a pension fund manager, will quietly sell your stock and walk away if they disagree with your strategy or if you hit regulatory trouble. But a retail investor base of 10 or 15 million people, that becomes a highly vocal, highly motivated voting bloc.
Because it's their retirement money.
Right. Politicians are very hesitant to aggressively regulate or penalize a company when millions of their own constituents hold that company's stock in their retirement accounts.
And when we talk about government contracts, regulatory battles, and political shields, we have to talk about the ultimate regulatory hurdle.
Yeah.
The Pentagon.
Well, yes.
SpaceX can dictate terms to Wall Street, and they can leverage retail investors against politicians, but they absolutely cannot dictate terms to the United States Department of Defense.
This is where the legal and regulatory complexity reaches its absolute zenith. Going public while serving as the primary backbone of U.S. space defense creates friction that is almost impossible to resolve cleanly.
The S-1 filing details how deeply integrated SpaceX is into national security. Their rockets, the Falcon 9, Falcon Heavy, Starship, they all fall under the U.S. munitions list, Category 4th. Their spacecraft hit Category XV.
Which means the government legally classifies them as weapon systems for export control purposes.
Exactly. And then there is Starshield. This is the classified, military-focused sibling to Starlink. We're talking about a $1.8 billion contract with the National Reconnaissance Office and a massive open-ended Space Force contract with a ceiling of $13 billion. The report mentions a classified constellation of about 480 satellites, with roughly 183 to 200 already deployed as of April 2026.
This deep integration means the company is subject to heavy scrutiny under CFIUS, the Committee on Foreign Investment in the United States, and rules regarding FOCI, which stands for Foreign Ownership, Control, or Influence.
Okay, let's break down FOCI. Imagine I'm an investor in London or Tokyo. What does FOCI actually mean for my ability to buy SpaceX stock?
Think of FOCI as the Pentagon's ultimate firewall. The Department of Defense grants SpaceX top-secret security clearances to launch spy satellites.
Right.
When a company goes public, anyone with a brokerage account anywhere in the world can buy its stock.
Right.
But the Pentagon assumes that if a foreign entity, a foreign sovereign wealth fund, or even a large foreign pension buys enough SpaceX stock to demand a board seat, that foreign entity might try to peek at classified satellite data or influence the launch schedule.
Which is a massive national security breach.
Exactly. So under FOCI rules, the Pentagon forces the company to build legal walls. If a foreign investor accumulates significant voting power, SpaceX will be required to implement what is called a voting trust structure.
What does that do?
This essentially blindfolds the foreign investor. They get the financial upside of the stock, but their voting rights are stripped away and handed to an American trustee approved by the Department of Defense. It completely neutralizes foreign influence.
And beyond just foreign ownership, how does SpaceX even describe its own business in a public document? The fundamental tension here is that the public markets demand absolute transparency, but national security demands absolute secrecy. When you file an S-1 to go public, you are legally required to disclose your material contracts, your operational risks, and your revenue metrics. But how do you disclose the revenue metrics of a classified spy satellite constellation without violating the Espionage Act?
You redact it heavily. The CLG report notes they will rely aggressively on SEC Rule 406 for confidential treatment and Item 601B10 redactions.
So it's like trying to sell shares in a nuclear submarine to the general public. You want the public's money, but you can't tell them exactly how the torpedoes work, how deep it goes, or who you are pointing the weapons at.
That is a very precise analogy. The SEC allows these redactions if disclosing the information would compromise national security. But it creates a bizarre dynamic for investors who are being asked to value a multi-billion-dollar segment of the business without actually being allowed to see the contracts.
And we are already seeing the political scrutiny surrounding this tension. The CLG report notes a letter sent in February 2026 by Senators Elizabeth Warren and Young Kim to the Defense Secretary, raising specific questions about foreign ownership concerns and indirect investments in SpaceX. Now, we are remaining strictly impartial here, just reporting what is contained in the text of the CLG analysis. But it highlights the stark reality that you cannot untangle a $1.75 trillion defense contractor from Washington politics.
The political scrutiny is unavoidable. The S-1 will be scrutinized by defense analysts and foreign intelligence agencies just as heavily as it is by financial analysts. It is a national security document wrapped in a financial prospectus.
Now let's zoom out. Because as massive as SpaceX is, they aren't executing this maneuver in a vacuum. SpaceX is just the tip of the spear in what looks like a massive, unprecedented year for IPOs, and they are navigating some incredibly treacherous macroeconomic waters.
The macroeconomic and sequencing context is critical. You cannot price a $75 billion deal without understanding what else is happening in the global economy at that exact moment.
The overall IPO market in the spring of 2026 is running incredibly hot. The Renaissance IPO index was up 10.4% in mid-April. Companies like Madison Air, Kylera, Figma, and Databricks are all performing incredibly well. But the real story is what Goldman Sachs bankers are calling the mega cycle.
The mega cycle, right?
It's not just SpaceX. We have Anthropic targeting an IPO in October 2026, looking at a $400 to $500 billion valuation and a $60 billion raise. And then there is OpenAI targeting late 2026 or 2027, fresh off a private round that valued them at $852 billion, where they just closed a $122 billion funding round.
This brings us back to your very first question about liquidity. If you combine these three companies, SpaceX, Anthropic, OpenAI, they could attempt to pull over $200 billion in primary capital out of the public markets in a span of about 9 to 12 months.
With 300 billion plus space and AI companies all trying to suck the oxygen out of the room at the exact same time, how does that even work? Do they just fight it out on the open market?
No, it requires intense behind-the-scenes orchestration. What we are seeing right now is a massive sequencing negotiation. These companies and their bankers are actively coordinating or fiercely competing to ensure they don't hit the market at the exact same moment.
I see.
If SpaceX and Anthropic tried to roadshow in the same week, they would cannibalize each other's order books. Institutional investors would force them to lower their valuations.
So it's a giant game of financial chicken.
Exactly. And it introduces massive execution risk.
Yeah.
Because the longer you wait to avoid a competitor's IPO, the more you expose yourself to macroeconomic shocks.
Right. Let's talk about those risks, because the S-1 is full of them. There's the technical risk right up front. Starship V3 Flight 12 is targeting May 2026. A massive explosion of a next-generation rocket over the Gulf of Mexico right before the June 8 roadshow would be disastrous for the narrative.
It would ruin the momentum.
Then there are massive macroeconomic and geopolitical risks. The report mentions Operation Epic Fury from February 2026 and an ongoing naval blockade of Iran, which has pushed Brent crude oil prices up to nearly $99 a barrel.
Geopolitical shocks of that magnitude tend to freeze IPO markets entirely. When oil spikes and supply chains are threatened, institutional investors get defensive. They move to cash or bonds. They don't buy hypergrowth tech stocks.
And beyond the macro environment, there are specific idiosyncratic risks tied to the company itself. The report explicitly lists the CEO's cognitive load and divided attention as a risk factor. You have Tesla missing Q1 targets and pivoting heavily to robotics in the cybercab. You have this massive XAI integration happening simultaneously. And there is an ongoing, highly publicized legal trial, Musk versus Sam Altman, that just started on April 27, 2026.
That is an immense amount of operational and legal distraction for a CEO who is supposed to be leading a $75 billion global roadshow.
And on the government side, the fragility of their federal contracts is highlighted. The NASA Artemis Human Landing System contract is actively being reopened for review, right as Jared Isaacman, who obviously has deep ties in the commercial space world, takes over as NASA administrator and navigates fierce competition from Blue Origin.
Yeah, that's a delicate situation.
Again, we are just looking neutrally at the facts as laid out in the CLG analysis, but the fragility of a $22 billion government portfolio when the CEO is highly politically salient is a real documented risk factor. The report specifically points to the political turbulence from the summer of 2025 as a concrete example of that fragility.
Every single one of these factors, a rocket failure, a sudden spike in oil prices, a delayed AI chip shipment, a political controversy, has the potential to derail the incredibly tight timeline required by SEC rules. As the report notes, they must publicly file the S-1 by roughly May 24, 15 days before the roadshow begins. The window for error is microscopic.
Okay. We have covered an immense amount of ground today, from orbital mechanics to Delaware Chancery courts. Let's bring this all together. We promised at the beginning to synthesize these CLG action items specifically for you, the listener. What are the tangible takeaways?
For anyone operating in the financial markets, the science of verification has never been more critical. You cannot take these numbers at face value.
Exactly. If you are an institutional investor, the report makes it clear. You have to start modeling that $10 billion cursor breakup fee immediately. It is a massive contingent liability sitting on the balance sheet. You also need to actively assess how the lack of voting rights for your shares will impact your eligibility for major indexes like MSCI, which often penalize or exclude dual-class structures.
And if you are a tech founder planning an IPO, this S1 changes your whole world.
It gives you rhetorical ammunition. You can now walk into a meeting with Goldman Sachs, point to Project Apex, and say, if SpaceX doesn't need a lead-left bank, neither do I. If they can demand a massive retail allocation to build a political shield, so can I. If they can escape Delaware and incorporate in Texas to protect founder control, why can't we?
For founders, it permanently resets the boundary of what is considered negotiable with Wall Street underwriters. And for the lawyers, accountants, and analysts, this S1, when it finally drops around May 24th, will be the most important disclosure document in decades. The precedents set here around AI governance, national security redactions, and capital formation will be studied in business schools for the next 50 years.
Which leaves me with one final kind of mind-bending thought to close this out. We started by talking about how an IPO is supposed to follow a well-worn playbook, how it's supposed to follow the standard rules of financial gravity. But when you look at Plan 2 of that compensation package...
The Mars colony.
Yeah. When the SEC and Wall Street investment banks and the world's largest pension funds officially sign off on a legally binding document that prices in a 200 million share payout whose sole explicit condition is the colonization of Mars, are we witnessing the exact moment the stock market ceases to be just a mirror of Earth's terrestrial economy and instead becomes the actual functional financial engine for the multiplanetary evolution of the human species?
It is a profound shift in the horizon line of global capital. We are no longer just pricing quarterly earnings. We are pricing the expansion of the human footprint into the solar system.
It really is incredible to think about. Thank you so much for joining us on this custom deep dive. We hope you've gained as much insight into the mechanics, the loopholes, and the sheer scale of Project Apex as we have unpacking it. Keep your eyes peeled for that May 24th filing date. Watch how the syndicate shapes up. And until next time, keep looking up.
Tune in next time on The Valley Current.